Hi, I'm George Bustamante at Caldwell Banker Commercial Blair here in beautiful downtown Long Beach. And we're a commercial real estate firm. I'm one of the principals here. I'm happy you're here today because I enjoy teaching and helping people invest in real estate. My motto is I help my clients create wealth through commercial real estate, one property at a time. So today I'm going to teach you a really important metric that's used by many of my clients, and whether you're a new client or an existing portfolio owner, this particular metric, which is called cash on cash return, is a really important tool. Hopefully you're already using it. Maybe I'll explain it a little better than you've been using it in the past. And if this is the first time for you, hopefully this will be very important for you. So let's dive into this right now. Here's what you're going to learn. You're going to learn, of course, the definition and an introduction to cash on cash return. You're going to learn how to calculate it. Very simple calculations. You're going to learn what affects cash on cash return. And of course, you want to know what the limitations are. That would be not very diligent of me not to explain the limitations. And then how do you apply it? Of course, that's the end. You want to have some kind of practical application. So let's talk about the definition, first of all, for cash on cash return. It's a simple measurement. It's an annual measurement. It just measures your cash flows and the return on those cash flows. The return on your investment from those cash flows. And it's a focus on cash flow. So why is understanding cash on cash important to you? Well, it gives you a benchmark to gauge against other investments, and it focuses on cash, which I don't know about you, but I like to look at my bank account and I start with $100, and at the end of the year I have $1,000. I feel like I've made money. It's that concept and it's that simple. So that's why understanding it is very important. It helps you with decisions. If you're looking at multiple investments, it helps you put them in some type of ranking so that you have an ability to go, this one has this return, this one's higher, this one's lower. If I add leverage, don't add leverage, which we'll talk about that later. Leverage is just the amount of mortgages or debt you're going to put on there. And then if you're an existing investor that has, multiple condos you've bought or apartments you've bought or a retail center you've bought, it'll help you analyze your portfolio on an annual basis just to see how you're doing, where your goals were, how you're doing today, and is it time to add more leverage and maybe pull money out and buy more investments. So the main thing is it helps accelerate your wealth, and that's what this is all about. I mean, let's face it, you have many choices on where you're going to invest your money and how you're going to do things. And so you need tools to help you evaluate where you're going, where you want to be, where you're going, and ultimately the goal is to hopefully have some fun in all of this. And this tool certainly is easy and certainly should be fun for you to look at a historical basis on what you're doing. So let's talk about a comparison to other investment methods, because my competitors are going to point out that I didn't point out the other obvious ones, which are cap rate is probably the most talked about one. So cap rate is an analysis of a return as well, but it just looks at net operating income over your overall investment, what my purchase price was. So I have a net operating income of $100,000 a year, and I have $1 million purchase price. It's a 10% return, but it's very limited on what it does. It doesn't take debt into account. It doesn't take a lot of things into account, and there's some things in there that are missing. So I'm not going to talk about that now, but hopefully in my future videos that you look at, you'll take a look at those and determine that it's something that's important for you to incorporate into your overall toolbox. The other one is net present value, or called NPV. NPV is you're taking the cash flows over a long period of time, discounting them back to get what's the value of those future cash flows today in today's dollar. If I earn $1 million over the course of 10 years and I apply a discount rate to it, come back to a value, I'll have an $800,000 value, for example, if I discounted it. And so I can take a group of investments and decide what's the net present value of each one, and which one ends up with a higher value for my value for today in 10 years. Then it comes out, that's the property I should pick. So a little more nuanced and tricky to calculate, but I just want to make you aware of it. The other one is internal rate of return, or also called IRR. Internal rate of return takes, again, a long period of looking at the investment from all cash in, the cash flows during the holding period, an exit cash flow from selling the property and distinguishing debt and coming out with what your net cash is, looking at that period of time, discounting it back, coming up with an overall return, an estimated overall return over that holding period, whether it's 10 years or 25 years. It's primarily used by institutional investors. Again, at some future point, I'll maybe do a video on that one because it is an interesting way to look at how an investment opportunity might present itself. But what's the advantage of a cash-on-cash return analysis? It takes leverage into account, and it allows you to apply this metric to determine how much leverage you really want to take. And I'll talk a little bit more about that so that you can kind of understand how cash-on-cash return and the calculation, how that will help you make better decisions on your investments going forward. All right, so let's deep dive into this. Let's talk about how do you calculate the cash-on-cash return. So here's the formula and the components of the formula. So the cash-on-cash formula is effectively cash-on-cash return is equal to your cash flow on an annual basis divided by your total investment. Okay, so what's your cash flow? You got to make sure you put in all the rent, all the expenses, and the debt service. No depreciation because that's not a cash item. And you determine how much cash you have from that investment, and you divide your total investment. And what's your total investment? I'll talk a little bit more about what's supposed to go in that total investment amount so your denominator, you make sure you capture the right investment number. So I'm going to give you a step-by-step example. And it's a very simplistic example just to make the concept solidify for you and make it easy. I mean, it's got to be easy or you're not going to use it. And hopefully the way I'm going to explain it right now, you'll grasp it pretty easily and you'll be able to incorporate whatever you're evaluating today. So for this example, I'm just going to use, we're buying an apartment building. You can use the same calculation for an apartment building, for an industrial building, for a retail building, whatever type of real estate investment you're doing, even a condo if you're buying a condo and renting it out. So for this example, I'm using a 12-unit apartment building. And my total cash invested, again, for simplicity's sake, is $100,000. And my annual calculation for my net cash flow out, not my net income, but my net cash flow out after debt service, is $10,000. So I take that $10,000, which is the cash flows, divide it by my investment amount, which I told you was $100,000, and I end up with a 10% return. It's that easy. So a 10% return. So let's talk about kind of what are some of the pitfalls that you have having a metric like this and making sure that you do it correctly so you end up with the right results and give you the right answers to help you with your choices. So what happens is typically is that you miss out on you omit certain cost on your investment. For example, that $100,000 I mentioned as your total investment in should include appraisal cost, loan points, consultant cost. If you pay your buyer broker, you're going to include those costs. Hopefully you're not including, your broker's not making you pay for it. Hopefully it's come from the seller. Whole different story or discussion. But it's all cost, all in. What do I have that I invested to purchase that property? Title cost, escrow cost, all those costs. So you want to make sure you classify those properly. And then you want to make sure you're not classifying cash flows inappropriately. So You don't want to have depreciation in there. You don't want to miss some of the revenues that you have, like laundry income, or you get the security deposit, but you don't include it as revenues in. That should be all included. Same with the expenses that you've excluded certain expenses. Sometimes people exclude capital improvements and want to capitalize those or move them out. No, you want all your cost in, all the revenues in, cash out, and don't forget the debt number, and include both the principal and interest. Some people like to exclude the principal, but you're not really getting that principal back. In the future, you'll get it back when you sell the property. But that'll give you a better picture of what your actual return on that investment is. So be careful with the accounting. Just make sure it's clean. Not that hard. You've got to do it for your tax work anyways, and make sure you're got an accurate picture of what your investments are doing. So what impacts your cash on cash return? So a big impact with real estate and cash flows is how much debt am I putting on? And so debt meaning how much of a mortgage am I going to put on? And there's limitations on how much mortgage I can put on, but ideally you want to put as little money down and try to leverage as much as possible, because you really amplify the return by doing that. But you have to be careful, because you want to make sure that you understand there's risk with having your property highly leveraged with a lot of debt. So typically, if I can put a lot of debt on there, a bigger mortgage, I have a very low investment. My return's going to be greater, or I know that I'm putting very little down, and I have an opportunity to move the rents up. My returns will just skyrocket. And so you want to make sure that you understand you get an amplification of the effect of the returns by having more cash flow, but there's also some risk by having debt. So I want to talk a little bit about how does the expenses and the income impact your cash flow? Well, first of all, rental income. That's the top line. That top line is typically at least 60 cents on the dollar that you collect as rent goes right to your cash flow. There's only about 40% of the expense. 40% is the expenses, and many times it's even lower than that. It's down as low as 25% over time, because rents are going up, and typically expenses are not going up at the same rate. Even if they are going up the same rate, if you have a 60-40 ratio, you'll understand really quickly that having a higher rent is always to your advantage in your long-term investing and your returns. So let's talk about rents a little bit. I know I have a lot of long-time owners. They don't like raising the rent. I've got a great tenant. They pay on time. They never call me, even when the place is falling apart. But I can tell you this, long-term, as a landlord, being a steward of your own investment, you want to increase the rents on an annual basis. Even if it's a modest increase, it only helps you in the long run from a valuation standpoint. If you ever have to go out and get another loan, if you are looking at your returns, you want to enhance your returns constantly. Or, for example, sometimes a municipality may impact your ability to raise rents because they put a rent control ordinance in place. So always look at that top line. Make sure you're collecting as much rent as you can. The other impact that kind of impacts your overall return is vacancies. And vacancies, I get landlords that own a retail center and they'll have that unit sit vacant forever. They don't want to hire a broker. But if they really calculated that they could get the unit leased faster, or an apartment unit or a condo unit, that if you lease it faster and quicker and get it back on the market and get a paying tenant, that your overall return will always be better. So vacancies. And sometimes you can't control rent increases, and you can't control vacancies because we have economic factors that come into play that we have no control over. But being aware of those is very important, because if you're watching what's going on and you're seeing the unemployment rates jumping up a little bit, and you're seeing vacancies jump up a little bit, you want to be proactive. Maybe you're going to lower your rents a little bit to be more competitive, but you want to fill that unit faster. You don't want those vacancies, because at the end of the day, it's about cash flow. So the other component that goes into your expenses impacting your cash flow is your repairs and maintenance. You want to make sure you're in control of all of that, and have a real diligent plan every time you're spending money on something that getting appropriate bids. The other big impact is management fees. Some of my clients like to self-manage. Others don't want to touch anything and they want to give it to a management company. Easy to factor in, get that calculation, make sure you understand that and what that dynamic is. Look, I self-manage a lot of my own properties. I used to, and sometimes I still do on smaller deals. And I have my partner who's in his 80s who pulls out that ladder when there's something to be done, climbs on a 10-foot ladder, takes care of whatever he has to take care of, puts his tool belt on and his paintbrush, and likes to do all that work. For him, I think it's a hobby, so he doesn't have a management company. So some people enjoy doing it. Some people are very handy. Others they just really want a passive investment. That's entirely up to you. Again, that's part of your targeting and your awareness of where you want to be on your cash flow returns. So I just wanted to touch on those as kind of impacts on your cash flows and make sure you understand those. So another thing that I would, my critics, again, my competitors would criticize is, not talking about the limitations of this metrics, cash on cash. It completely ignores the tax issues and the consequences of tax issues. Again, that's a separate video, and I could talk for an hour on tax implications. So for this purpose and for you to just take to that next step for either growing your portfolio or starting your investment journey, this tool doesn't take taxes into account. It also excludes appreciation of your asset, which, let's face it, at the end of the day, most of my clients, they bought a nice little condo for $100,000 down by the beach several years ago, and now it's worth $1 million. It's one of their biggest assets. It doesn't take that into account, but I can tell you this: if you're minding the cash flows and watching your returns during that 10-year journey, the appreciation will be there, and it's the cherry on top of this sundae. Okay, so just remember that. So that's why it's just not included in the analysis for cash on cash returns. So it doesn't take into account long-term growth, and it excludes appreciation. Not to worry though, there will be appreciation if we're in a decent market, and the marketplace is always cyclical, so it's always going up and down. But long-term, most of my investors that I work with have been investing for a long time. Even the new ones, years later, have told me, I'm so glad I bought whatever I bought, even if it was a bad market. So just keep that in mind. So what's the practical application of a cash-on-cash return, and why would you want to put this in your tool belt and your quiver to have as a tool to analyze things? So it helps you define your investment goals. So I only want to look at investments that I'm going to have a 5% return. I only want to look at investments that have a 10% return. It just helps you solidify where your goals are. And also, you can use it now to determine if I'm looking at 4 properties, I want to set a target, and am I hitting those targets with those 4 properties and then analyzing? And some of them might have opportunities where you can raise the rents in a dramatic way. Others might require a lot more capital outlay, so your returns are going to be lower initially, but you can increase the returns later. So it just helps you set those goals, and it helps you guide your investment decisions, and that's what this is all about. You want some guidance. You don't want to just go blindly and point at one and go, this is it, this is the one, just because the broker told you this is the best thing since sliced bread. You have your own measurements and your own goals and your own decision-making tools that now you can, dictate what you want and how you want it and why you want it. So it's great for property comparisons, whether it's within your portfolio. If you have a portfolio, like I said, maybe you have 10 condos or a few retail buildings, it helps you adjust and look at those, analyze those, and when you're making an investment, if I had this example of 4 properties, I can now measure which ones are better for me to really pursue. And then it also helps you assess the cash flow efficiencies of each, what you have existing or what you may be buying. And what you have existing, you may want to look at, I may want to re-leverage because I have so much cash flow. I can pull out, for example, I put in $100,000 originally, but I can pull out $50,000. I've just increased my cash cash on cash return almost double. And I'm not taking into account the debt because you're going to increase the debt a little bit, but usually the multiple is definitely there. And that's really long-term investors, the power of remortgaging and pulling out money, taking that original investment and buying another investment. Now they have two properties. I have clients that started out with one small little a duplex or a condo and have built a tremendous portfolio by just using this concept over and over again. So let's get to, that's kind of the practical example and analysis of this, so that hopefully solidifies this concept in a real basic, easy way. And I kind of look at it as, okay, tell me, how does this apply to me and how does it help me? So if I have one investment choice and it has a 10% cash on cash return, and I have a second investment that has a 25% cash on cash return, what does that mean? It means my 10% cash on cash return, I would get 100% of my investment, my original investment, back in 10 years. That same investment, if I'm getting a 25% investment, it would only take 4 years. Now, I'm not that smart, but if I could get my investment back in 4 years versus 10 years, I think it's easy to see which one is better. So I know that's an extreme example, but it's about nuances. It's about just getting 1 percentage point better than the other one. And that's what this is all about, and it's long-term thinking. So it matters to you because your investment comes back to you faster, and that's why a better, higher cash-on-cash return is always kind of an easy decision-maker tool for you. So that's it. It's that simple. Hopefully I gave you one nugget that will help you do this. I can tell you this, there's a lot of different ways of looking at investments. This one here is probably one of the easiest, but probably one of the most powerful tools you can use, especially whether you're an early on investor, first time investor, or whether even you have multiple properties. If you're not doing this, if you own multiple properties, I bet you use some form of a cash on cash analysis throughout your career. So I just wanted to conclude that if you have any questions, I love talking about real estate or answering questions, so you can always get a hold of me and we'll put up the information for you for my phone number. I'm at Coldwell Banker Commercial Blair here in Long Beach, downtown Long Beach, and I'm helping you, again, building your wealth through one real estate investment at a time. So I'd love to do that, and hopefully you will have some questions and you'll watch my future videos. Thank you.